Hey everyone, my name is Aryan. I get asked this question quite frequently, which is how do I go about investing in the Australian stock market? How do I go about buying and selling shares? What is the stock market? How do I wrap my head around this whole concept? Well, I thought, you know what, it's a very valid point, especially for people who are starting out the whole investment journey. The stock market can be quite daunting and can also be quite stressful because it's end of the day, your money going to the stock market, and it's very important to understand the whole stock market a lot better. And this is exactly what I want to do in this video. I want to talk a bit about the stock market. I want to talk about how to go about buying, selling shares, some few key pointers to remember or note when starting out your whole investment journey. And hopefully by the end of this video, you'll have a better idea of the stock market. You can basically understand it a lot better, and hopefully it'll help you in your investment journey. Now, of course, I'm not a financial advisor. This is purely based on my own opinion, my own knowledge, and my own research, which I want to share with you. And hopefully you learned something new from it today. So without further ado, let's get right into it. So the first thing I guess very important for us to understand here is, what is the stock market? What is the stock market really all about? Well, to put it in very simple terms, stock market is a public place which allows individuals and institutional investors to buy and sell shares. Now, thanks to the technology, you can do it all electronically and online. Now, to understand this whole concept a lot better, let's take an example. You've got a company called XYZ Company. Now, this company wants to, of course, have some money or raise some money so that it can grow or expand into, for example, let's say the US market. So this company has a few ways to actually raise money. Well, one of them obviously is going to a bank and taking up a loan. But another thing as well which they can do is they can go to a private firm or private investor and raise some money from there by giving them some equity. And maybe another way is also the shareholders putting more money into the company, or also one of those other ways is listing their shares on the stock market, which is basically publicly listed company now they become. So of course, for a company to go publicly listed, there's a few procedures which take place, which are done by a lot of financial institutions, done by brokers and etc., where they decide, okay, at what rate will this company go per share price and how many shares are going to get issued. And that's all decided by the financial institution and of course by the brokers and of course by the auditors and things like that. Now, think of it as this very simple example. We've got the XYZ Company. They want to raise about $40 million. So now, based on the evaluation done, probably $1 per share, let's take it as. So there's going to be 40 million shares issued in the stock market. So they're going to be issued, and what's going to happen now is the day when it goes IPO, which is now it's going to go initial public offering at $1 rate. So it's going to be sold to a lot of investors. It could be institutional investors, it could be individuals. That's basically now it's available in the stock market. So what happens is investors can buy those shares, and now they're holding a share unit or a number of share units of that particular company. And of course, through this procedure, the company raises $40 million, which it needs to expand in the US market. Now, what happens with that issued shares? It's now in the stock market, spread among various different investors who bought in at the initial public offering, and now they sell it among different investors in the stock market. It would be various different investors, and they basically place a bid on that particular share price or an offer on that share price, and if the bid is what is the asking price, then it is basically sold. And that's generally how the stock market works. Now, if you ask me what's the point of holding a share unit of that company, well, it's because of two particular reasons. The first reason, of course, being you get voting rights. So when you're holding a share or a share unit, you are now a holder of a part of that company. So of course you get voting rights on any of the decisions made, and that is one of the benefits. But a bigger benefit of this whole holding the shares of a company is the capital gains and dividends. So that is basically the money you make of holding the shares. So if you ask me what is dividends, well, to put it in very simple terms, a company generates revenue, generates profits. Now, if there is any excess profits, they can distribute that among the different shareholders, which is basically X amount of dividends issued per share, and how many shares you're holding is the amount of dividends that you get. So that is basically as simple as that for dividends. And what is capital gains on the other hand? Capital gains is the share price when it goes up that is a capital gain. So let's say you bought it at $1.10 and now the share price has gone to, let's say, about $2. So that difference of about 90 cents is the profit you make per share unit. And that is called the capital gains. Now, these are the essential core factors of why you want to buy and why people, in fact, buy and sell shares of a company. Now, the big question here is, how do you buy and sell shares? Well, it's actually quite simple nowadays. Back in the day, it was a lot harder to buy and sell shares simply because you needed a broker and it was done via the telephone and a bid offer would happen. And if it was a bit too late, then the offer will be invalid. But nowadays, it's a lot simpler because everything's instant thanks to technology. And now you've got apps for trading and you've got so many different trading platforms. Even the 4 big banks help you buy and sell shares in the ASX stock market. So for example, you got CommSec, you got NabTrade, then you got Westpac and you got ANZ who provide all their own trading platform. But then you've got the less popular one as well. For example, Selfwealth, Superhero, IG, CMC, and a lot of other ones out there. Now, of course, the crucial or critical part is when you are buying and selling shares of a particular company or organization or whatever it is, of course, there is a transaction fee cost. And that is the fee which the broker charges you in order to buy or sell shares. Now, of course, this fee is very critical and sometimes it can be somewhere around $10, maybe even $20 or even more, a percentage based on the value amount of what you are buying or selling. Now, that's why it's very important to choose the right broker platform because sometimes these fees can be quite expensive. Now, of course, just buying and selling shares isn't just what the broker platforms are for. There's a lot of other benefits. For example, you can create a watch list and keep track of stocks that you're interested in and read announcements of companies, get news and updates, for example, maintain your portfolio, and various other things you can do via all these platforms. Now, I'll let you basically decide which platform suits you, but it's very important to keep all these factors into consideration. Now that you know a bit more about what the stock market is and how to buy and sell shares, I think the next big question here is, how do you invest in the stock market? What shares to actually buy? What shares to avoid? What investment style to go ahead with? And all that sort of stuff. Well, it's a lot complicated, those questions, and there is actually probably not any right answer towards it. There is no right answer to it, but there are a few guidelines or tips which can help you in your investment journey, and especially when you're starting out your investment journey. Now, of course, as a beginner, I would definitely recommend to go for ETFs. Now, what are ETFs, if you ask me? In simple terms, they're exchange traded funds, which are basically a managed fund which is a collection of different stocks. Like for example, you've got the ASX Top 200, that could be one ETF, and now it's a collection of all those 200 different listed companies in the ASX stock market, the top 200. And now let's say if you buy into that ETF, like let's say $10,000, you are putting or distributing your $10,000 among those 200 different stocks that are there. So it is basically buying fractions of each of those companies. Now, of course, there's a percentage of how much each share you'll hold because, of course, the higher the share price of that particular company in the ASX Top 200, the lesser you will hold or the lesser fraction you will hold of that particular company because of the share price that it simply is. Now, of course, there's a lot of different ETFs out there. There's growth-based ETFs. There's, for example, dividend-based ETFs. There's top 200 ETFs. And there's different ETFs out there. Not only that, but there's also Vanguard, then there's BetaShares, the different providers out there. It's a very big topic, the ETF. I might make a separate video down the track talking a bit more about ETFs in detail. So if you haven't subscribed already, please do subscribe and turn on notifications to stay updated. But talking about ETFs, I definitely recommend when starting out your whole investment journey to go with safe ETFs, such as, for example, you've got VAST and you got VTS. Those are basically holdings of a lot of different companies who are in the top 200, top 300, and you just basically holding them. It's less volatile simply because the top 300 are usually stable stocks, and most of them also provide dividends, which are a great benefit towards investing because, of course, you can take out that dividend or you can reinvest, which I always recommend reinvest your dividends simply because it adds the whole power of compounding. Where the power of compounding is basically, just to put it in simple terms, let's say you buy shares of that whole ETF and now they give you the dividends, and then what you do is you buy with those dividends more of those shares, and through years you're building it up, and now you have a bigger portfolio, bigger number of shares, and in return you're getting more dividends. Now, also talking about the whole power of compounding, it's a very important thing, and I always recommend to keep investing in the stock market, not just the dividends, but also your own money, your own savings, a portion of it. It's a very important thing because it keeps compounding, and through time you will build that portfolio, and in return you get a lot of money. Best example, take Tony Robbins, what he said. In Unshakable, Robbins uses a hypothetical example to illustrate the mathematics. There are two friends that are same age, Joe and Bob. Joe begins investing US $300 in the stock market every month from age 19 to 27, saving total of US $28,000. Bob does the same, but from age 27 to 65 for a total of $140,000. The stock market in this example grows annually 10%, a number chosen for simplicity. By age 65, Joe has about $1.8 million and Bob has $1.58 million. Now you can see that difference right there, and that's why I say the power of compounding is very important and it plays a big factor. So always keep investing a portion of your savings into the stock market, regardless of whether it's up, whether it's down. Now that's all about ETFs and compounding, but let's say you don't want to do ETFs. Let's say you don't want to invest in ETFs. Well, there is this other sort of investing, and that is investing in stocks individually. That is buying and selling shares of companies individually, but it is a bit more complicated. And it is for people who are a bit more experienced in the stock market, because you just can't randomly pick out a stock and add it to your portfolio. Because if you do it randomly, chances are it might not be a good investment and it's more like gambling. So for you to pick a right stock, there's two things which you really need to do when it comes to as individual. And that is the technical analysis and fundamental analysis. Now, talking about these two types of analysis, technical analysis is more about looking at charts, looking at graphs, looking at basically the trend of the stock, where it's heading, and the history of it, and things like that. So that's the technical analysis. And then you've got also the fundamental analysis, which is understanding the company, understanding the governance, understanding the revenue, understanding the whole business model and things like that, and getting a whole idea of the company. And these two things are quite crucial for you to be able to make a better judgment if that company is worth adding to your portfolio or not. Now, of course, there's a lot of benefits when you get really good at fundamental analysis and technical analysis, because this way you can pick stocks into your portfolio, add them and remove them as required. And this way you can focus on whether you want high capital gains or you want high dividends and things like that. And then this way you can probably achieve a higher yield or a higher return on your capital. But also consider this: when you're buying individual stock, the risk is a lot higher. You can lose a lot of money in your investment as well. So if there's three things that you could take away from this video, well, number one is make sure you pick the right trading platform. It's very important to pick the right trading platform, not just the fees, but also the platform itself. Like, is it reliable? Is it like, what features does it have? How does it show the graphs, the info on the stocks and things like that? It's very important to pick that right one. And then second thing is, if you're starting out your investment journey, go for ETFs. But if you don't like the whole concept of ETFs, then go for individual stocks. But make sure you do your research about that stock before investing, especially the technical and fundamental analysis. It'll help you a lot in deciding whether it's worth investing or not. And there's a lot of resource out there online, just on forums, on different YouTube videos. Even my channel, I post a lot of videos doing technical and fundamental analysis of different companies. So if you're interested in that, do subscribe. But then third thing and foremost important thing is the whole compounding effect. And what I mean by that is, just take some portion of your savings and put it in the stock market. Through time, you build your portfolio, and in return, you get larger gains and you build a lot more wealth. I hope you enjoyed this video. If you did, please do give it a thumbs up on YouTube, and please do subscribe to my channel, where I post a lot of videos like this covering investment topics, talking about stock trends, and doing stock analysis of different companies. So if you're interested in that sort of topics, please do subscribe. But until the next video, take care. Bye-bye.